Hello everyone, this is Nabil Qureshi, a qualified chartered accountant from Texacolega with another video on moving your rental business into a limited company and avoid an immediate CGT or SDLT bill. So stop scrolling. Here's how it can or when it cannot. You can sometimes defer capital gains tax when you transfer a property business into a company in exchange for shares. That is called incorporation relief, but it only applies if the property is run as a genuine business. That means not passive buy to let holdings, and SDLT rules are separate. In many transfers, SDLT still applies unless very specific partnership incorporation rules are met. Let me briefly explain to you what is incorporation relief. If you transfer your business and all its assets except cash to a company in return only for shares. Any gain on the transfer is rolled over into the share-based cost. So you don't pay CGT now, you pay later when you dispose of the shares. It's automatic if conditions are met. You don't need to tick a box, but the rules are strict. You generally need to be either a sole trader or a genuine partnership running a property business, not just passive investment. Plus, the transfer must be the business as a going concern, and the consideration must be shares or mainly shares. If you take cash as well, that part is taxable immediately. Okay, so SDLT is different beast. HMRC will normally charge SDLT when land is transferred for consideration. If you transfer property to a company, even if the company issues shares, instead of paying cash, HMRC can treat the transfer as having a deemed market value and charge SDLT accordingly, especially where parties are connected. That means deferred CGT does not automatically mean no SDLT. There are narrow SDLT reliefs, most commonly when a genuine partnership transfers property into a limited company owned by the partners. So partnership into company incorporation rules. In the right circumstances and timing, that can reduce or eliminate SDLT. But the tests are strict and HMRC looks closely. If you're thinking of moving properties into a limited company, here is a quick checklist for you. Number one, is your property activity actually a business? If yes, you must document trading activity, hours, services, and management. Number two, were you a partnership or a sole trader? Please note that the partnership history can unlock SDLT relief in limited cases. Number three, are you being paid any cash on transfer? Cash is equal to an immediate CGT on that part. Number four, do you have a mortgage and lender consent? Lenders often need to agree and remortgage at company level. And lastly, number five, do you have a valuation report? The SDLT may be calculated on the market value if shares or connected parties are involved. So talk to your accountant and conveyancer. These transactions need coordinated tax, legal, and mortgage work. HMRC has been targeting property business incorporations. They'll probe whether it's a genuine business and whether the partnership rules are being used correctly. Mistakes can mean unexpected CGT bills, SDLT, penalties, and interest. So if you are a landlord thinking of incorporating, don't guess. Book a free 15 minutes review with Tax Liga. We will check whether incorporation relief or SDLT partnership relief might apply or not, and outline the practical steps so you are HMRC proof. In the end, I must tell you that this is not a personal tax advice. Rules change and every case is different. Contact Tax Legal Chartered Accountants for bespoke advice by visiting our website www.taxecliga.co.uk. Thank you.